Welcome to video 1 of Analyzing Business Performance. So, we've come to the end of the year, we've created a profit and loss as well as a balance sheet, and now we want to know, how did we do? If we look at our profit and loss statement that we created in our past video, we can see all of this information. But what does it really tell you? Yes, we made £96,160 profit, net profit, but is that good? What was our goal? What did we make last year? How could we compare that to other companies of different sizes? So, there are three main categories of ratios that we use to analyze our business performance, to really look at the numbers of what we got and analyze them in a way that lets us compare them. But before we do that, we need to know why we do that. There's no point in doing an activity if no one cares about it, if no one wants that information. So, why must we analyze performance? Well, these are some of the people who care. Managers want to know how the business is doing so that they can effectively manage it going forward. Employees might be interested to know if the business is doing well and be able to continue to pay them. Shareholders want to know if the business is making enough profit to be giving them dividends. Along with our creditors who we owe money to, our competitors obviously want to know what and how we are doing, as well as our customers. Lots of people care, and therefore we find it very effective to use simple ratio calculations to help us see more clearly how our business is doing. In this video, we're going to be focusing on our profitability ratios. And as it says here, this allows us to compare how profitable our company is compared to other companies, no matter how big it is. Yes, Apple makes more profit than your local corner shop. However, they may not be more profitable based on what they have to work with. So these formulas, these three ratios that we're going to calculate, help us compare businesses that normally we would not be able to compare. Our first ratio is called the gross percentage of sales. It's calculated by taking your gross profit, dividing it by sales, and timesing it by 100 to get a percentage. If we stop there for a minute, and opposed to just going through the motions and using a formula, really think about this. If we look at our title, our gross percentage of sale, we're really looking at what percentage of our sales, or the revenue, the money that we're bringing in by doing business, is turning into gross profit. Remember, gross profit is not our final profit. Our gross profit is simply our revenue minus our cost of sales. It's how much money we're truly making each time we sell something, but that then needs to go and cover the other costs in our business. Okay? So when we do this calculation, we're going to get a number. Okay? It's going to be less than 100. And so the statement we tend to make is that for every £1 in sales that the company makes, that answer that you get, that number that you get, is how many P you have left as gross profit. Again, what portion of that initial £1 of money coming in do we keep as gross profit? Okay, so let's try it out. If we look at our profit and loss statement, on here we can find our gross profit as well as our revenue or sales. So we'll be able to do this calculation. So we want to take our gross profit, divide it by our sales, and times it by 100. And we find out that we have 53. So for every £1 in sales, the business is making 53p. That's what's left as gross profit, or 53%. Generally, we would think that this is a fairly good gross profit. We want our gross profit to be more than at least 50%. However, we can't get the whole picture from this, and this is why we do three different formulas. Again, gross profit can be something that we use to compare to other years' data. So if last year we had 63 and now we have 53, then our 53 may not be as good because it's gone down from last year. Next, we're going to look at our net profit percentage of sales. As you can see, the title and the formula are very similar. It's just this time we're talking about net profit as opposed to gross profit. Net profit is our final profit, and so we tend to care a little bit more about this formula. So we take our net profit, we divide it by sales, and we times it by 100. And this tells us that for every £1 that we make in sales, this is how many P or what percentage of that is left as your overall profit. Basically, how much are we actually making each time we sell something? So again, we can go back to our calculations, and all the information we need is on our profit and loss statement. So we're going to take our net profit, divide that by our sales, and multiply it by 100, which gives us 21.6, so about 21.5 P, or 21.5%. Okay? Again, we like to think this is fairly good. We are making a profit each time we sell something, and we're getting to keep about 20% of every pound that we make in sales as profit after we've spent all of our money. These formulas are most generally used to help us control costs in the business. Okay? Just like in gross profit, if we see a change, if one year the net profit went down, the percentage went down, then we know that maybe we're spending a bit too much money. The reason we do the gross profit and net profit is because they show us the different types of expenditure. So, if your gross profit has gone down, then that means your cost of sales per item has gone up, and those are the costs you need to look at. Whereas if your gross profit percentage stayed similar and your net profit percentage went down, that would mean that it's your expenditure or overheads that have gone up in relation to your sales this year, and those are the costs that you need to consider and manage. Finally, our last formula in this section is what we call return on capital employed, or ROCE for short. This formula is separate from the other ones that we were looking at, and our calculation is our net profit, so how much profit we made this year, divided by something that we call capital employed, and then times by 100. Okay, so your net, or your ROCE, return on capital employed, is really looking at how much profit are we really making in relation to the money that either the bank or our investors have given to us, invested in us to make that money. How well are we doing at making money on the money we borrowed? So, our capital employed includes our equity, our owner's equity from the second half of our balance sheet, as well as our long-term liabilities, so the money invested and the money that we got from the bank. Again, what this tells us is for every £1 invested in the business, either by the owner or the bank, we are giving them back, we are making back in profit what percentage of it. So, if we go back here, we don't want our profit and loss statement this time. We need our balance sheet. So, if you recall, our formula is to take our net profit and divide it by our capital employed. So, our net profit, if you recall, was £96,160, and we are going to divide this by what we call our capital employed. Remember, this includes two numbers, so we need to put it in brackets, and we need to take our capital, our owner's capital, and we need to add it to our long-term liabilities, so this bank loan here. Close our bracket, and remember to times it by 100. So, our result is 64.4, or basically rounded to 65. So, for every £1 invested in the business by the owners of the bank, we are making 65% of this back. So, is it good or not? Well, we need to think about it this way. if the bank or if the investors did not give us the money, if they did not give the money to our business, where would they have put it? Okay, most likely they would have put it in a bank account. Bank accounts give us interest. So generally right now it's between 1 or 2%. At most, a large amount of money is going to get about 5% interest. So if the bank is offering 5% interest and we're making 65% interest, it's likely that investors are going to want to put their money in our business. We are making money with the money they invest. We are making money and therefore are most likely able to give it back to them. So having a good ROCE, or return on capital employed, allows us to be confident that if we needed more money, we could go and get it from investors, as well as having a good indicator to say we are being successful. So these are your 3 profitability ratios, and these will help you understand if your business has been profitable, as well as helping you compare your profitability to other businesses.